Welcome to vTalkInsight, Risk Sentiment Daily for December 20th, 2025. Markets are leaning back toward risk-on, even as yields, policy, and AI valuations pull in the opposite direction. So today is about understanding which forces really matter for portfolios right now. Equity markets are ending the week with a cautiously risk-on tone. The S&P 500 gained close to 1%, and the VIX slipped back below 15, pointing to firm risk appetite and a calmer volatility backdrop than we saw earlier in the month. Under the surface, leadership is still tech-heavy, with gains in AI and semiconductor names, but performance has broadened out. Financials, industrials, and even parts of healthcare are participating, which suggests investors are not just hiding in a narrow handful of winners. At the same time, this is not an all-clear environment. Bond markets remain uneasy about long-end yields, central bank messaging is mixed, and macro data are noisy, especially around U.S. inflation and the consumer. Compared with the more defensive tone earlier in the week, when AI and growth stocks came under pressure, today's setup looks more constructive, but still conditional. Investors appear willing to add risk, yet they are very aware that higher yields or a policy misstep could quickly reverse sentiment. Three bullish forces stand out. An AI-driven earnings and productivity boom continues to support growth expectations and index-level profits. Dovish Fed expectations and better liquidity underpin a soft landing narrative. And strong equity inflows alongside broad earnings upgrades are keeping the equity risk premium supported. Pulling the other way, rising global yields and term premia, especially after the Bank of Japan's policy shift, are a growing headwind for valuations. Policy uncertainty and geopolitical tensions are elevating tail risks. And AI and tech valuation and funding risks mean the very engine of this bull market could become a source of instability if sentiment turns. Put together, that mix argues for a late cycle, selectively risk-on environment. Investors are still being paid to own growth and earnings momentum, but they are increasingly discriminating between beneficiaries and potential casualties of tighter financial conditions and policy shocks. In that context, today's risk sentiment is best described as cautiously risk-on rather than euphoric, with volatility low but not fully pricing the macro and policy risks that are clearly building. AI-driven earnings and productivity boom remains the central bullish narrative for global equities. Mega-cap technology names, often grouped as the so-called MAG7, continue to deliver strong double-digit earnings growth and upward revisions, even as the broader index sees more mixed guidance. Forecasts now point to accelerating earnings growth for these leaders into late 2026, widening the performance gap with the rest of the market and reinforcing the idea that AI is not just a theme, but a multi-year profit cycle. The macro data are starting to validate that story. Measured U.S. productivity has averaged around 2% year-over-year over the past 3 years, roughly double the post-financial crisis norm, and AI integration into core business processes is a key driver. Enterprise demand is shifting from experimentation to full-scale deployment. Inference workloads are ramping, data center capacity needs are exploding, and companies like Micron have underscored this with outsized earnings beats and guidance tied directly to AI demand. That boom is not confined to software and chips. Hyperscalers and infrastructure providers are committing enormous capital to data center buildouts and energy solutions. Oracle's aggressive long-term data center lease commitments are one example of how corporates are positioning themselves as key infrastructure partners for AI platforms. This is also spilling over into commodities. AI-driven data center expansion and stationary storage batteries are expected to account for a meaningful share of demand growth in copper, aluminum, and lithium next year, contributing to a constructive backdrop for several metals. All of this supports the case for resilient earnings at the index level and helps explain why equity strategists are comfortable projecting double-digit profit growth through 2026. AI-led productivity gains and revenue visibility cushion some of the downside from a softer consumer or higher funding costs. However, there are caveats. Concerns are rising about how sustainable the AI earnings cycle will be beyond 2026, and there are already signs of rotation within the trade as investors become more selective. That means AI remains a powerful tailwind for risk sentiment, but one that is increasingly sensitive to quarterly earnings, financing conditions, and evidence of genuine productivity gains rather than just narrative. Dovish Fed, liquidity, and soft landing expectations are the second major bullish driver. Policymakers describe current U.S. monetary policy as mildly restrictive and broadly appropriate, with no immediate pressure to hike further. The Fed's focus is on steering inflation from roughly the high twos back to its 2% target without inflicting unnecessary damage on the labor market, reinforcing the idea that the next decisive move is likely to be easing rather than tightening. Recent inflation prints have cooled to the lowest core readings in about 4 years, and most CPI components are now running below 3%. Bond markets have moved to price a continued Fed rate cutting cycle into 2026, and yields have eased across the curve over the week despite a daily uptick. On top of that, oil markets are in a clear supply glut, with Brent projected in the mid-$50 range or lower, which is disinflationary at the margin. Together, these forces support the view that the Fed can continue cutting without immediately re-stoking inflation. Liquidity is expected to improve meaningfully in the first quarter, as the Fed is seen expanding its balance sheet sooner and more aggressively than previously anticipated. That shift, combined with expectations for a steeper yield curve and lower front-end rates in 2026, is a constructive backdrop for risk assets. Fiscal policy is also additive. In the U.S., fiscal measures are expected to contribute roughly 80 basis points to GDP in 2026, mainly in the first half, while in Europe, large-scale German infrastructure plans and collective EU borrowing for Ukraine point to a more supportive fiscal stance. These policy and liquidity dynamics underpin a soft landing baseline. Despite a softer labor market and elevated unemployment, the U.S. economy is expected to remain resilient, with consumer spending helped by upcoming fiscal transfers and tariff refunds. The risk, however, is that inflation proves stickier than these benign scenarios assume, or that noisy data lead to a policy error. Some Fed officials remain wary of cutting too fast, and bond investors are acutely sensitive to deficits and long-term inflation expectations. That tension between the desire to ease and the need to maintain credibility will be a key driver of risk sentiment into 2026. Strong equity inflows and earnings upgrades are the third key support for risk appetite. Recent weeks have seen record inflows into global equities, including the second largest weekly flow ever into U.S. stocks, even as macro and valuation uncertainties persist. Investors are clearly favoring equities over bonds, with tepid demand for fixed income funds reflecting discomfort around the interest rate outlook and a desire to capture equity upside while the growth narrative remains intact. Earnings revisions are backing up those flows. Forecasts call for S&P 500 earnings growth of about 11% this year, 12% next year, and further expansion into 2026. The high revision cohort is dominated by cyclical sectors such as technology, real estate, and financials, while traditional defensives like healthcare and staples lag. Outside of tech, travel and leisure have emerged as bright spots. Companies like Carnival, Marriott, Airbnb, and premium cruise operator Viking are reporting strong demand, improved pricing, and upgraded profit outlooks, helped by lower fuel costs and resilient discretionary spending. Market structure is also turning more supportive. A record options expiration has cleared significant positioning overhangs, allowing indexes to trade with fewer mechanical constraints. Options flows show persistent call spread buying in major tech names, indicating investors still want upside exposure, but with more risk control. Looking ahead, a substantial IPO pipeline adds another dimension to this risk-on tone. High-profile names in AI and space are expected to come to market over the next couple of years, and portfolio managers are eager for new large-cap stories to diversify away from a shrinking public equity universe. That said, the earnings and flow story is not uniformly positive. Consumer sentiment is hovering near historic lows. Low-income households are under pressure, and staples are seeing volume weakness despite price relief. Pockets of the market, such as late-stage AI names, also show clear signs of froth. The takeaway is that while earnings momentum and inflows are powerful bullish forces, they coexist with meaningful micro and macro fragilities. This is encouraging for risk assets in the near term, but it makes the market more vulnerable to disappointments in growth, policy, or funding conditions. Turning to the main headwinds, rising global yields and term premia are front and center. The Bank of Japan has raised its benchmark rate to its highest level in 3 decades, pushing 10-year Japanese government bond yields above 2% and signaling a clear break from the era of ultra-low Japanese rates. That move is feeding directly into global bond markets. Higher Japanese yields are putting upward pressure on long-dated U.S. Treasuries and European bonds, and markets are increasingly focused on the risk of Japanese capital repatriation reducing demand for foreign sovereign debt. Europe adds another layer. Rising euro area yields are being driven by expectations of heavier collective debt issuance and Germany's record borrowing plans, at a time when the European Central Bank is seen as slower to cut rates. The EU's €90 billion loan program for Ukraine and Germany's broader €500 billion infrastructure initiative support growth but also elevate fiscal and term premia concerns, particularly for more indebted countries like France and Italy. In the U.S., strategists highlight the importance of key yield thresholds. 10-year Treasury yields are projected by some to hover near 4.15% into year-end, a level markets can digest. But a sustained move above 4.5%, and especially toward 5%, is seen as a potential breaking point for the equity bull narrative. Higher long-end yields compress valuation multiples, raise the hurdle rate for corporate investment, and undermine the traditional hedging role of treasuries in balanced portfolios. Rising term premia also interact uncomfortably with leverage strategies in areas like private credit and AI data center financing. What complicates this picture is that volatility in rates has actually fallen, with the U.S. bond market's MOVE index at its lowest level since 2021. That suggests a degree of complacency about the potential for further shocks from Japan, Europe, or U.S. fiscal dynamics. Some investors are responding by favoring the 5 to 10-year segment of the Treasury curve, which historically benefits from flight to quality during equity drawdowns. But as long as long-end yields and term premia remain under upward pressure, they will serve as a persistent drag on risk sentiment and a key trigger to watch for any shift back toward risk-off. Policy uncertainty and geopolitical tensions form the second major cluster of risks. At the domestic level, the ongoing selection process for the next Fed chair remains unusually open, with multiple candidates still in play and markets scrutinizing every signal from Washington. At the same time, divisions within the Fed and rising political pressures threaten its traditional consensus-driven approach. Noisy inflation data, including acknowledged anomalies in recent CPI reports, heighten the risk that policy decisions are made on imperfect information, increasing the chance of a perceived policy mistake. In Europe, the EU's decision to finance a €90 billion zero-interest loan to Ukraine via joint borrowing, while deferring the use of frozen Russian assets, underscores both fiscal solidarity and political divisions. Russia has warned that any seizure of its immobilized assets would be destabilizing for the global financial system and has threatened legal action. Repayment of the Ukraine facility is implicitly tied to future reparations or the use of those frozen assets, leaving uncertainty about who ultimately bears the credit risk. That ambiguity feeds into sovereign spread pricing and raises the specter of future governance disputes within the EU. U.S.-China tensions remain elevated even as specific deals, such as the proposed TikTok-U.S. restructuring, offer partial relief. Washington has enacted legislation expanding authority to restrict U.S. investment in Chinese technology firms, particularly in dual-use AI and semiconductor sectors. Export controls on advanced chips are being handled separately from broader trade talks and are explicitly driven by national security concerns, meaning they are likely to stay in place regardless of any tariff negotiations. That keeps a cloud over cross-border capital flows and supply chains in critical technologies. Beyond China and Europe, geopolitical risk is visible in multiple arenas. Nation-state adoption of crypto for sanctions evasion, large-scale hacks attributed to North Korea, and ongoing conflicts that could affect energy supply, even if current oil markets are oversupplied. Looking ahead, the run-up to the 2026 U.S. midterm elections, combined with potential Supreme Court rulings on trade and tariff powers, introduces an additional layer of policy volatility. For markets, that means higher event risk premia, greater sector dispersion, and a heightened sensitivity to headline flow around trade, security, and fiscal decisions. The final key risk is AI and tech valuation and funding risks, which sit uncomfortably alongside the very real earnings strength we discussed earlier. Late-stage AI company valuations in private markets are trading at roughly a 250% premium to non-AI peers, and some fundraising rounds have seen headline valuations jump from about $500 billion to well over $800 billion in a short space of time. Investor demand is being driven in part by fear of missing out, with large planned raises for high-profile names signaling that capital is still readily available, even when near-term fundamentals are hard to justify. At the same time, there are emerging signs of funding strain. Concerns about the scale of capital expenditure required for AI data centers and energy infrastructure are particularly acute for companies with weaker balance sheets or higher debt loads, such as some legacy technology vendors. In public markets, concentration risk is rising, with technology and information services now accounting for nearly half of the S&P 500. That increases the vulnerability of the index to any reversal in AI sentiment or funding conditions. Recent volatility has already produced a reset in some overvalued AI and tech names, though renewed flows into U.S. equities and a drop in volatility indices have quickly followed. Options activity reveals a cautious stance. Investors are buying upside in major tech stocks, but are also more actively managing downside via spreads rather than outright calls. Looking forward, many expect the AI trade to evolve from broad sector beta to a more selective focus on companies with clear free cash flow generation and multi-quarter revenue visibility. That implies a likely shakeout in weaker stories and greater dispersion among AI-exposed names. These valuation and funding vulnerabilities matter because AI has become the core pillar of the equity bull case. If financing costs rise due to higher yields, or if investor patience with long-duration AI projects wears thin, the resulting correction could have outsized effects on index levels and on correlated assets such as high-yield credit. For now, strong earnings delivery and robust private and public market demand are offsetting these concerns. But as the cycle matures, AI and tech are likely to be both the engine of returns and the primary source of potential drawdown risk, underscoring why this remains a critical area to monitor. To sum up, markets are ending the week in a cautiously risk-on mood. An AI-driven earnings and productivity boom, dovish Fed expectations, and strong equity inflows and upgrades are anchoring the bullish narrative, even as rising global yields, policy uncertainty, and stretched AI valuations keep tail risks very much alive. For portfolios, that mix points to an environment where growth and liquidity still support risk assets, but where shocks to yields, policy, or AI funding could trigger rapid reversals. Watching how bond markets digest the Bank of Japan shift, how inflation data evolve, and how AI capex is financed will be crucial for gauging whether this risk-on phase can extend through 2026. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.